Welcome to the Be Smart podcast, How Not to Be an Idiot with Your Money. We do have a big announcement today about the podcast, which we'll save for the end. But Jared and I were just talking. I wore my Dodgers hat today to see if I get a rise out of him. What are you thinking? We got a collision course between LA and Seattle?
Yeah, it kind of looks that way. I really don't want Seattle to win. I don't. Even though it would mean they get off the schneid, because they've never won before. But I don't like Cal Raleigh. I think he's a jerk. He makes fun of Aaron Judge for hitting basically meaningless home runs in blowout games and stuff like that. So I prefer the Dodgers win, honestly.
Did he win MVP or something like that, Cal Raleigh?
So it's a horse race between him and Judge for MVP.
And when did they decide that?
I don't know when they vote on that. It's shortly after the season, I think.
Okay. What's going on new with you? I listened to your latest mix, which was excellent. Proof of Heaven.
Usually when I do a mix, I have a couple of tracks that I'm really, really excited about. They're my favorite tracks, and I kind of build the mix around that. This one, I just wanted to create a soundscape that was really smooth that you could get lost in, It's funny because, I have such a trained ear listening to DJ mixes. I can always tell the transitions between tracks. This mix, I literally cannot tell. I just totally get lost in it.
Very smooth. And it starts nice and slow, kind of melancholy, which I like. And it does build over time. It's I hope this isn't reductive to your music or anything, but it's the perfect music to put on and get some work done. You just kind of get in the zone.
If you're listening to this, go to SoundCloud, find me on SoundCloud, DJ Stochastic. All my mixes are up there. Proof of Heaven is the new one. You can click on that.
You want to get in the market headlines here, starting with stocks? I mean, they're down, they're up, they dip again, they're bouncing back again, I see today. But earlier this morning, the Dow, S&P, and the NASDAQ slid as U.S.-China tensions rattled nerves. China has placed sanctions on 5 U.S.-linked units of South Korean shipbuilding firm Hanwha Ocean, effectively barring Chinese companies from doing business with them. Both countries also began charging special port fees on each other's vessels on Tuesday in a bid for maritime dominance. This naturally soured, at least temporarily, the mood after Monday's strong rebound from last Friday. How are you feeling about stocks after these latest moves? Was Monday a temporary relief bounce?
As you know, I don't really pay a whole lot of attention to the news. I pay attention to the technicals. And Friday was an interesting day. We were down 3%, which is really a 3 standard deviation day. And there was some pretty massive liquidation going on. It got a little panicky towards the close. It was funny. I was on Twitter over the weekend, and Raoul Pal, who is a good friend of mine, basically said that it was kind of flash crashy and that, usually in those situations, the market goes back to unch and then goes higher. I'm not entirely sure. There's a huge amount of leverage in the system. There's a huge amount of leverage in the stock market. I don't think it was all deleveraged in one day. As you can see from the price action today, it got a little iffy on the open. So I'm positioned short at the moment, not massively short, but I am positioned short. I may regret that, but that's my thinking going forward. And look, if you want to talk about the tariffs, I do think they are going to get resolved. I think this 100% tariff is going to go away. I think the U.S. and China are going to come to an agreement. Trump, this is classic Trump shock and awe type of stuff. I think a deal is going to get done, and that would actually be a bullish catalyst. But I'm bearish on the market for other reasons like private equity and stuff like that.
I want to get to this idea of the potential for a bigger correction. Jamie Dimon has publicly warned that he's far more worried than others about a serious market correction over the next 6 to 24 months. He's actually warning of a risk of an American stock market crash. He wrote, I would give it a higher probability than I think is probably priced in the markets and by others. So if the market's pricing in 10%, I would say it is more like 20% or 30%, excuse me. Do you agree, disagree? And should investors be looking to position themselves for a late cycle regime? Is it time to trim, hedge, rotate into anything?
Do you know who Mark Spitznagel is? Are you familiar with that name?
No.
He runs a hedge fund called Universa. They're based in Miami, and Universa is a tail risk hedge fund. So they just go around buying crash puts on stuff. They buy crash puts on stocks. They buy calls on VIX. They buy calls on bonds, like basically just crash stuff. And they've done pretty well over the years. Spitznagel's an interesting guy. He's written 2 books. I read his most recent book. And he recently came out and said that he thinks the stock market is going higher, that it's basically going to explode in a supernova. And the analog is 1929. Like, he's saying this is going to be like the crash of 1929, which is interesting because I never heard anybody come up with that analog before. But it's actually, I don't know, it kind of resonates with me. I mean, I hope it is in 1929, because what happened from 1929 to 1932 was that stocks went down 89%. So I sure hope stocks don't go down at 89%. That would be bad. But no, I do think it's an interesting analog.
Gold and silver. Let's start with silver just for context here. Silver broke out to an all-time high as a historic short squeeze in London added to momentum fueled by surging demand for safe haven assets. Spot prices for silver hit a record of $53.55 an ounce in London before edging lower. The record silver auction was set on January 18, 1980 at $49.45 an ounce. So I'm seeing this from Forbes. Analysts warn of risks as silver's price surges. Analysts are saying that the metal is likely to continue its rise amid the government shutdown and expected interest rate cuts. Both gold and silver are considered safe haven assets, but Goldman economists anticipate more volatility and downside price risk for silver. And unlike silver, gold is backed by demand from central banks. Do these run-ups in silver and gold give you any pause? I mean, I assume they don't change your core position, but in terms of adding, or if people are interested in adding here and getting more exposure, what are your thoughts?
Well, let's talk about silver first. So silver has a squeeze in the spot market. Like, there were people short spot silver that have to cover, and inventories in London are very low. So there just isn't enough silver. So there's a squeeze going on. And how you can tell that is that spot prices are trading above futures prices. Usually it's the other way around. Usually futures prices trade above spot prices. So now it's totally inverted. It got to like $3 a couple of days ago, where spot was trading above futures. So the only thing I'll say here is that in situations like this in commodities, just get out of the pool. Adult swim, get out of the pool. It's too dangerous. You could literally, and like, no joke, you could have a squeeze to 100 in a day, or you could have like a crash to 30 in a day. Like, that's how volatile it is right now. So, I'm just, like you said, the core position, I'm sticking with the core position. I'm not trading it here. Too dangerous. It's nuts.
Yeah, gold is still climbing. I also saw that central banks now hold more gold than U.S. Treasuries. For the first time since 1996, foreign central banks' gold reserves have overtaken their U.S. Treasury holdings. Persistent gold buying and rising U.S. debt risks are reshaping reserve composition toward hard assets. Does this make you even more bullish on gold's long-term prospects?
As a percentage of reserves globally, gold is about 14%, 12%, something like that. That could go to 20%, 30%, 40% for sure. I mean, if you go back to the 2000s, you said 1996 was the last time this happened. Central banks were selling their gold in the 2000s, in the late 90s, because they thought it was useless. Like Gordon Brown famously sold all the UK's gold basically on the dead balls low at like $265 an ounce, sold all their gold, and now it's trading at 4,000. So there was some bad idea bears out there.
I got one more headline for you. JP Morgan to invest up to $10 billion in U.S. companies critical to national security. The move is part of a broader 10-year, $1.5 trillion initiative to facilitate finance and invest in industries central to the growth of the American economy, including defense, energy, and advanced manufacturing. Is this a rise of political and industrial investing? Because a lot of capital is shifting toward these policy-driven sectors.
Yeah, it is. And also, like, this happens like basically right at the top of a bubble where like rare earths and defense tech and, metals and uranium and all this stuff is like ripping, like it's what's fashionable right now. If JP Morgan invests 1.5 trillion in this, my guess is it's going to take 20 years to break even or turn a profit.
Main topic. I want to discuss this idea of hedge when you can, not when you have to. How key is hedging to your investing philosophy? And are there times when you don't need to hedge?
So I know where you're going with this because I wrote in my newsletter that there are times when you don't need to hedge. But I pretty much always have some kind of hedge on. Like the way my brokerage account is set up is I have the main brokerage account where I have all my stocks and gold and stuff like that, GLD. And then I have an options account, which is basically where I hedge, where I buy puts on stuff. And, really the best case scenario is the market keeps going up and my puts go to zero and I spend that money on a hedge and I didn't need to use the hedge, right? But if the market goes down, I am making money in the options account while I'm losing money in the main account, and then I'm hedged, right? So like I said, I usually have something on as a hedge, whether it's puts on SPY or individual stocks or private equity or whatever. And one thing I've always said is you don't want to build a shrine to your hedge. You don't want like a humongous hedge. You don't want to be in a position where you actually want the stock market to go down, because in general the stock market doesn't go down, right? So like basically you want to insulate yourself from volatility and protect those gains when you have to.
So for like hedge position sizing, where do you usually lean there? I mean, how much of a percentage of your portfolio?
Let's say you had $1 million portfolio, you'd probably want to hedge 400,000 of it, 500,000 of it, something like that.
Looking at the week ahead, the BLS is putting out a key inflation report on October 24, despite a government shutdown that is delaying most government data. The CPI report for September was originally scheduled to go out on October 15. What else we got going on this week? Anything?
I think that's the only
Powell spoke
data
today.
That's coming out. Yeah, it looks like Rick Reeder is going to be Fed chair.
Really?
Yeah, I think we're kind of trending in that direction.
Interesting. So we teased an announcement at the beginning of the episode. Jared, do you want to drive this vehicle, or do you want me to run point on this?
You go ahead.
So I am going to be taking a step back from the Be Smart podcast to focus on some other projects. I believe we're going to take a short hiatus, but the plan is to bring the podcast back, and I have no doubts that when we do, it'll be better than ever. If you have any suggestions on the direction of the podcast, please let us know in the comments. I mean, how long have we been doing this, Jared? How long have you been doing this?
Quite a while. I mean, look, like the podcast is coming back. Like it's not going away forever. I built a damn podcast room in my house. I have to use this room. Like I need to do a podcast. Also, I think Jared Dillian Money should have a podcast. I think we should have a podcast. It just kind of, like you don't want things to get stale. We want to do it. Next time we bring it back, where it's going to be bigger and better. We're going to figure out ways to improve it, So I'm excited about it. But you need a break. I'll take a little bit of a break, and we'll be back.
We'll be back, and I'll still be working behind the scenes, so not going anywhere.
Yep.
Jared, thank you for your time. It's been real. I'll talk to you here soon, and peace out.
See ya.